slides and get started because I want to be sure we have enough time today to go through everything as well as go through your personal tax savings estimate. So my name is Andy Smiles. I'm the Director of Customer and Product Marketing here at Collective. We'll talk a little bit more about Collective in just a moment, but I will be your webinar host today. Thanks so much for joining. So what we're going to do today is we are going to have a quick overview about what is an S Corp. Then we're going to get into calculating your tax savings. We're going to do this live together. So we'll share a link with you and I will go through how to use the calculator and we'll talk a little bit about what your results mean. Then we're going to talk a bit more about how to get started with an S Corp. If you are going to have some tax savings, your next question you probably have is now what? And then we'll have a live Q&A at the end. For the Q&A, please put your questions in the Q&A box, not the chat. The chat is really hard to keep track of for Q&A, and the Q&A box is just a lot easier for me. I can guarantee to answer everybody's questions. I can mark which ones I've already answered. Just keeps me more organized. Now, a quick note from our legal department. This webinar is for educational purposes only. Nothing contained in this or any other related webinars should be viewed as legal or tax advice. For you, every business is unique, so please be sure that you consult a professional if you need legal or tax advice for your unique business. Now, as I mentioned, my name is Andy and I work at Collective. Collective is the first all-in-one online financial platform designed for self-employed people. So what does this mean? Because there's a lot of words on the screen. Well, this is what your money looks like when you are self-employed. There's a lot of stuff you got to think about and keep track of. Taxes, estimated taxes, your bookkeeping, your business setup, retirement, financial reports. It's a lot. And what you'll find is that when you need to make a financial decision or when tax season rolls around, all of these things are suddenly connected. And your bookkeeping impacts your taxes and your financial reports impacts your taxes, but your business setup also connects to your ongoing compliance. See, it's so complicated, I can't even say the words out loud. There's a lot of stuff going on and everything is connected. When we're at Collective, everything is all under one platform. So this is what we mean when we say we're an all-in-one financial platform. We take all of these different parts of your business finance that are connected, but are also often very overwhelming to manage, and we put them under one platform. So bookkeeping, taxes, business setup, estimated taxes, so on and so forth. So you feel nice and organized with your financial back end. We'll talk a bit more about Collective a little bit later on, but I want us to start talking about S Corps. So you're here today to unlock the savings potential of an S Corp, see how much you could potentially save with an S Corp. But before we do that, we want to understand what exactly is an S Corp, because there are some common misconceptions about S Corps. So before we even talk about S Corps, we need to talk about the concept of a legal structure. So an LLC and a corporation are a type of legal structure. And legal structures are formed in your state, usually with the Secretary of State. So when you form an LLC, you're not forming that under the federal government or the IRS, you're forming that under your state itself. So something like an LLC requires a formal organizational process. This is a key thing to keep in mind about legal structures, is that it requires actual paperwork submitted to your state. Every state is different, so what this process looks like will differ state to state, but you will have to go through a formal process of organizing your business as a legal structure. Again, LLCs and corporations are both very, very common types of legal structures that you've probably heard of, and you may even have already, like an LLC. So when you have a legal structure, you are required to file an annual report, letting the states know who manage the entity. So this again is going to vary state by state. So some states require this every year, some states don't require it at all, some states require it every other year. Sometimes there's even fees attached. But essentially, one thing you want to think about with legal structures like an LLC is that it can introduce more paperwork into your business. So why am I talking about legal structures where you're here today to learn about S Corps? Well, a very, very common misconception about an S Corp is that it is a legal structure. And an S Corp is not a legal structure. An S Corp is a tax election for your legal structure. So basically what happens is the IRS decides how each business structure is taxed. So the IRS makes a decision that if you structure your business like an LLC or a corporation, this is how you're going to be treated from a tax standpoint. But the IRS also allows some legal structures to change the way that they are taxed. So if you don't like the way that you're taxed as an LLC, and we'll get into comparisons a little bit later on about what this looks like, but if you don't like the way that you're taxed in your current legal structure, like an LLC, you can ask the IRS to change your tax treatment. And one of the tax treatments you can ask the IRS to tax you as is an S Corp. So the key thing to know here is that an S corp is also is a tax election. So if you are a LLC and you become an S corp, you are really still an LLC. You are just having your S corp taxed, or having your LLC taxed as the S corp. So I'm going to say this again because I feel like I didn't say that very clearly. You want to think about the LLC as the foundational part of your business. So the foundation is the LLC, and then you're going to layer the S Corp on top of it. So we often use the words like, I'm an S Corp, I became an S Corp, I'm forming an S Corp. Really what you are as an S Corp, we're going to go with being an LLC because I don't want to get us complicated into other legal structures. Really what you are is you are an LLC taxed as an S Corp. So sometimes you might see content floating around the internet, and we do it too, LLC versus S Corp. Really, what that content is about is LLC with the default tax structure versus LLC taxed as an S Corp. Of course, saying LLC taxed as an S Corp over and over and over again is a lot of words, and everyone is going to zone out. So we just shorthand everything to S Corp. But it's very, very important that you understand what's actually happening here in your business, and that when you become an S Corp, you are not giving up your LLC. Now, you might be thinking, okay, I don't have a legal structure. Does that mean that I can become, what does that mean? Like, if I don't have an LLC, can I still become an S Corp? No. You cannot go from being a sole proprietor to an S Corp. There has to be that legal structure in between, right? So that legal structure is sort of that bridge to the S Corp tax treatment. So if you are a sole proprietor and you're hearing me say all this stuff about LLC and S Corp and how an S Corp really is just an LLC tax as an S Corp, and you're like, I don't have an LLC, I don't even know like where to start, you need to start with the legal structure. So you go from sole proprietor to LLC to the S Corp tax election. Okay, so let's talk now about what it's like to be taxed as an S Corp. So we've got the baseline concept that when you are an S Corp, you are still an LLC, right? You are still your legal structure. You've just changed the way that you are taxed. But why would you want to change the way you're taxed with an S Corp? Well, S Corp owners don't pay self-employment tax on their business profits. And if you've been self-employed or if you've been taxed as a sole proprietor at all, you know that self-employment tax is a killer. In fact, self-employment tax is 15.3% of your business profits. It's a lot. And then you have income tax on top of it. It's a lot. So with an S Corp, you are not paying self-employment tax on your business profits. Instead, what's going to happen is that your S Corp creates an employer and employee relationship between you and your entity. So you have to think about splitting yourself into two here. And the S Corp employer you is going to hire the personal you, the owner you, and you will become an employee of your own business. And you become required to pay yourself what's called reasonable compensation through payroll. So you effectively are getting a payroll salary from your business, and your business, the S Corp, gets to write off that salary as a business expense because you're now treated like any other employee. So what's happening with your wages, your actual salary that comes out of the S Corp? Well, they are subject to payroll tax, which is 15.3%. Now you might go ding, ding, ding in your head and say, she just said self-employment tax is 15.3%. It is. It is the same type of tax. It's doing the same thing, which is essentially paying into your Social Security and your Medicare taxes. Now, with being an S Corp and an employee, that 15.3% that is a subject on your wages, half of those taxes are withheld from your paycheck. You've ever been an employee before, you know what that's like, right? You have those payroll tax withholdings. Half are an expense for the S Corp. So the S Corp is now writing off half of these taxes, half of your Social Security and Medicare taxes as a business expense. So the S Corp is employing you, it is writing off your salary, and is writing off half of your payroll taxes. So what about you? What about the personal you? Because we talked about this. You're kind of split into two now. So you have the S Corp you and the personal you. Well, the personal you is going to report your S Corp pass-through profits and employee wages as your personal income. And then you pay income tax on both. So let's look first at, we're going to break this down because I know these are like words on the screen and it's probably still a little fuzzy, like what's really happening. We're going to go through this one more time and show the flow of how you're taxed and then show how this can potentially save you money. So get really clear on like what is driving the tax savings in all of this. But before we do, we're just going to take a very quick look at how you're taxed as a sole proprietor or an LLC. So a single member LLC and a sole proprietor are taxed the exact same way. So essentially what's happening is you have your revenue, which is all the money you earn from selling your goods and services. And then you're going to subtract your tax deductions, right? Your expenses. And what's left is your net income. And if it's a positive number, it's profit. If it's a negative number, it's a loss. Regardless of if you have a profit or loss, when you're a sole proprietor or an LLC, because single member LLCs are default taxed by sole proprietors, as sole proprietors, that profit or loss is going to pass or flow through to your owner tax return. So this is a good thing because your business doesn't have to pay taxes at the corporate level. It's just passing through to your personal tax return. And then we talked about this. We have our self-employment tax, that 15.3%, and we have our income tax, which has a lot of factors involved in it, and it can range from 0 to 37%. Now, this is how you're taxed as a sole proprietor. Let's look at the tax structure of the S Corp so we can start pointing out the differences of what's really happening here. So we still have our revenue here at the top. This is the money that you earn from selling your services or goods. But now we have our expenses plus our salary. Because remember, as the S Corp, you are going to become an employee of your business. So we have our operating expenses, and then we have our salary, our owner salary. And then we have those payroll taxes, that 15.3% that is assessed on your salary. So now what we're going to do, you're going to take our revenue, we're going to subtract our expenses, we're going to subtract our salary, and we're going to subtract half of our payroll taxes. And that is going to give us our S Corp profit or loss. And that profit or loss is going to pass or flow through to your owner tax return. So again, this is good because even though it's called S Corp, you don't have to pay corporate taxes at the federal level. We like this because this helps you avoid double taxation. So this is a good thing. So the S Corp profits or losses pass through to your owner tax return. And that's what you're going to report along with your salary, because your salary is just regular W-2 income. So if you've ever had like an employee job before with a paycheck, that's called W-2 income. And you're going to receive one of those from your S Corp. And now suddenly on your own tax return, you're saying, okay, I made this much in salary and my S Corp had this much profit that passed on to me. That's what you're reporting. And then we have your income tax. So you do pay income tax on your salary and profits, kind of like, you know, income tax is always around. But what the key thing is here, you are not paying self-employment tax on those profits. The self-employment tax is only assessed on the salary. So how does this help you save money, right? So it's like, okay, got it. no self-employment tax, cool, but like, where is the tax savings happening? Like, how am I saving money on the taxes? Well, let's look at this example because this really illustrates what's driving the tax savings. So we have the sole proprietor, the single member LLC, because remember, they're taxed the same way. And then we have the S Corp. Remember, the S Corp is really an LLC taxed as an S Corp. That's what it is. But again, too many words to put on the screen. So this is an example of somebody who has $160,000 in profit. So if they're the S Corp, they're going to pay themselves $60,000 in that owner's salary, right? That owner wage that we keep talking about, that's going to be payroll to you. And let's look at what's subject to self-employment or payroll taxes, because remember, those are both 15.3%. Well, the sole proprietor, it's the business profits, right? It's all the business profits. That's $160,000. That's subject to that 15.3%. With the S Corp, it's just your wage, which is $60,000. So in this example on screen, there is $100,000 that is not subject to 15.3% in taxes as the S Corp. That is what's driving the tax savings. And you can see that here on the next line. It's simply math. If you do math, at this point, it's an exercise in math. Well, with more income subject to those 15.3% in taxes, those Social Security and Medicare taxes, you pay more tax. With less income subject, you pay less tax. In this example, it is a $15,000 difference. So what's really driving the S Corp tax savings is the owner wage. Now, I'm going to get back to that in a moment. But before I do want to talk about the last two lines of this chart, which is the pass-through profit. Now, for the sole proprietor, the pass-through profit's all of it, right? It's just kind of all flowing down. Sometimes I think of it of like, you know, when it rains a lot and a gutter gets full and everything just kind of like flows off onto the ground. That's kind of what it's like. It's just all flowing down. There's really nothing in between. Your pass-through profit is 160. Your taxable personal income is 160. It's just all passing through. But with the S Corp, it's not like that gutter that's full. There's some things that are happening in between. So the pass-through profit is $100,000. Why? Because your owner wage is $60,000 and is going to be a tax deductible expense of the business. It's going to reduce the pass-through profit, right? 160 minus 60 equals 100. So the pass-through profit is a little bit less, but the taxable income is the same. Why? Because this owner wage is still personal income to you. So this owner wage is still going to be part of your taxable income. So I always say the TLDR of this slide is that you are saving more on taxes while you're making about the same amount of money. Okay, so I did promise to get back to this point about owner salary. How much do you pay yourself? You want to pay yourself a reasonable compensation. And basically what that means is that you need to pay yourself something that is reasonable for the work that you're doing and the amount that your business is earning. If your business is profitable, let's say your business in this case is making $160,000 in profit, $0 in payroll is not a reasonable salary. So there does need to be some kind of reasonable wage happening there. And you really want to think about it as a tax strategy where you're striking the balance between having S Corp tax savings, but you're not underpaying yourself either, because you want to be within the rules of the IRS. It's like, what's reasonable? What is the IRS going to accept as reasonable? And what is also going to save me money? Unfortunately, the IRS doesn't have like a fund flow chart or calculator where you can go on and say, I'm a marketing consultant in California. What's reasonable compensation for me? They say it's a facts and circumstances argument. So you do want to be thinking a little bit about, what really makes sense. Okay, so that is our primer on S Corps. We're going to get into the fun part of this, which is The calculator. So Sarah has shared a link in the chat. I actually have it open here. I'm going to go over it. We're going to talk about how to fill this out. We're going to talk a bit more about some of the considerations. And we're going to do this live together so you can see what your potential tax savings would be. Okay, so this is our calculator. It's totally free to use. It's ungated. You don't have to put in like an email address or anything like that. You can just use this anytime you want. It does all the math for you, which is why we like it. So we're going to start off with what services do you offer? I'm going to say I'm coaching and consulting. Now, the next step is to add if you have any additional earnings from other W-2 jobs. If you are somebody that your business is your side hustle and you have another job, like a W-2 job, you would want to put that in here like this. Or maybe your business is your main hustle, but you do still do some other work on the side. You maybe want to put that in here like this. So if you have another job that is running payroll for you, which means that you are a W-2 employee, you are going to enter this information here. Now, the next step is you're going to put in your annual business revenue. So revenue is before expenses. So it's not your profit, it's your revenue. So let's say that I'm making $150,000 in my business in revenue. And next we're going to put in the amount of expenses. So this is what you plan to write off on your taxes by the end of the year. So you should have a general idea of like what your expenses could be. We have some examples here: travel, software, subscriptions, contract labor, advertising. It's the stuff you spend on your business to keep it operational. I'm going to say in this example, because I'm a consultant, my expenses are pretty minimal. We'll say $30,000. Now I want to put in my hourly billable rate. So this is pretty straightforward. This is just what you're going to charge your client, broken out per hour. So it's, this is an area where you don't have to be perfectly precise. If you're somebody who works on a project basis, you may be thinking to yourself, I don't know, just kind of get a ballpark range. So I'm going to say $150 an hour. That's a pretty usual rate for a consultant. And then you want to put in the number of hours a week you spend on your back office. So the amount of time you take doing your bookkeeping, organizing your books, figuring out your taxes, figuring out your estimated taxes, all of that stuff. So when I used to be self-employed. So when I was self-employed, it was about 2 hours a week for me. All right, here is the part that is where the magic happens. You are now going to use this slider to decide of your profits, how much of it will be salary and how much of it will be distributions, essentially your pass-through profit. So I could say, I want to pay myself 50-50 split, right? I want to do 50% of my S Corp earnings or my S Corp profits are going to go to my salary. 50% will go to my distributions. Maybe I'll take it down to 40. Again, taking it down to 5, 10, even 15, 20 may not be something the IRS is going to love. The good thing about this calculator is it enables you to play around with some of these numbers and kind of see the results of these things. But keep in mind that this is the part that is reasonable compensation, that you want to be doing something reasonable in the eyes of the IRS. So I'm going to bring mine up to 40. I feel like that is a good, reasonable number. And now I'm going to hit calculate. So what I see here is my total savings. This is time and tax. 26,000, but we get a little bit more of a breakdown here. So the tax savings in this situation is $11,000. So based on the parameters that I put in here, I would save $11,000 in taxes as an S Corp for the full year, right? So if I was an S Corp for all of 2024, this would be my estimated tax savings. But there's time savings as well, because at Collective, and we'll talk more about this in a bit, we also help you with your bookkeeping, your taxes, your estimated taxes, basically the financial back end of stuff that can be quite Time consuming for business owners, especially business owners who aren't accounting experts, right? Because it isn't that you couldn't DIY it, it's how much time is it actually taking you versus an expert. So the time savings is also here as well. This is the billable time savings that you get back. So if you basically, we're saying here is that if you had back this time in billable hours, so if you didn't have to do your back office work every week, we were doing it and you had this time back in billable hours, you would have $15,000 more in billable hours. That's where this total number comes in. So we see 11K. Now, I do want to demonstrate a few things here with the reasonable compensation, which is if I were to bring this all the way up, let's look at what happens to my tax savings. So if I bring my reasonable compensation all the way up to 90% is coming out as an S Corp salary, I have 1K in tax savings, right? So I'm not really saving anything because remember, as a sole proprietor, the way that you are taxed is that all of your business profits is subject to these 15.3% tax. So here, I'm basically almost replicating that structure. Now let's see what happens if I bring this all the way down. Well, woohoo, my savings number went up, which can feel very, very exciting. But remember, we need to do something that is reasonable within the eyes of the IRS. And in most cases, paying yourself 5% of your salary, which in this case would be, I have to do math now. 120 times 0.05 would be $6,000 a year based on these numbers that I have here. So paying myself $6,000 in salary a year when I'm profiting 120 would be pretty unreasonable in the eyes of the IRS. So that's where this comes into play. It's really finding that sweet spot of, is it reasonable and am I still getting some level of tax savings? So this is a free tool. You can use it anytime. I recommend that you play around with it and start using it to see what your tax savings could look like. I also recommend that if you're a newer business and you've done this tool, and let's say you're like here, let's bring this even down. Let's say you're somewhere around here because you're new and you're getting started. And again, the tax savings are just really not there for you. That's okay. You can come back to this tool. You can come back in 3 months when you think you're going to be earning more money and look to see what this might look like again, right? So it's something that you should, and you really should come back to it. If you're not finding a lot of tax savings in your current state, you should be revisiting this every 3 to 6 months, depending on the pace of growth in your business, and checking again to see if it's a right time for an S Corp. Okay, we're going to come back here. We played with the tool. So I want to talk to you all a little bit about one quick thing. So this tool that I showed you is based on an annual savings number. So you might be a little bummed out because you're like, well, it's June and this is an annual savings number. So is it really worth it for me at this point? Well, if you are an existing LLC, I do want to let you know that Collective can backdate your S Corp through January 1st. So if you are an existing LLC and you're playing around with this and you're like, man, I just missed out on like $5,000 in tax savings, so I didn't do this earlier and I really should have, fear not. Collective can help you backdate your S Corp to January 1st. Now, keep in mind, this is only for existing LLCs. So if you are a sole proprietorship, unfortunately, it's not possible. It's not like legally possible to backdate the S Corp. But hey, look, 4.5K in savings is still something. It's still something to consider. You know, it isn't nothing. So if you are a sole proprietor, it still may be worth it for you to switch, even though you're doing a mid-year election. So let's say you played with the calculator. You're like, ooh, I get tax savings. This is cool. But what does this all really look like in practice? Well, to get your S Corp set up, you're going to need to create the LLC. We talked about that earlier. You need to get your LLC set up first. And that's going to look like filing paperwork with your Secretary of State and any other state required paperwork. Remember, LLCs are formed under the state, which means that the process is going to vary state by state. And then you'll also want to file your S Corp tax election. So this is the paperwork where you ask the IRS to tax your LLC as an S Corp. Now, before you can do that, you need to get an EIN with the IRS, and you'll need to file the S election paperwork. So there's a couple steps. And then you also need to register for a payroll account because now you are an employer of yourself. So you now need to go through the typical things that one would do in order to become an employer, even though you're just employing yourself. And then you'll need to work with your tools. So you'll need to set up your bookkeeping tools. Now, a lot of people ask, well, why do I need a bookkeeping tool? If I'm an S Corp, why can't I just do what I did with my spreadsheet? Well, your bookkeeping has now become more complicated because you have payroll. There's more things involved with payroll. There's all sorts of deductions and withholdings and so on and so forth. And you really are at the stage now where you should be investing in quality bookkeeping tools and software or a bookkeeping service like Collective. And then you'll also want to invest in payroll software. Another big question, why can't I just DIY my payroll? You could DIY your payroll, there's no law against it, but payroll is a very complicated process. Payroll is an extremely complicated process. There's a lot of math, there's a lot of tax tables involved. There's also different agencies need to have withholding sent to them at different points in time. And if you don't send your withholdings in on time or you don't file your payroll tax returns on time, you get penalized. So it is possible to DIY it, but for the stress and the time and the work it would cost you, you're better off with a payroll software that's going to automate all of that and ensure that everything is making it to the right agencies at the right time and that all of your returns are filed. And then you'll want to set up your money flows like your business bank account and your business credit card. You want all of this to be created under the LLC. So this is what it looks like to get your S Corp set up. Let's talk about how to operate the S Corp. Well, you're going to need to file your business and personal tax returns. So we haven't had a chance to talk about this yet, but your S Corp will have to file its own business tax return. Even though it doesn't pay taxes at the federal level like a C Corp would, it still has to file an informational tax return. So this is a little bit more paperwork for you. You'll also need to file your payroll returns. We just discussed that. And you're going to need to maintain your entity. So if you aren't already an LLC and you're not used to having an entity to maintain, this looks like filing your state paperwork and paying any state fees if those are required of you. And then finally, you have to keep up your books and your tax obligations. We recommend that you do your books monthly, and then we also recommend that you pay your estimated taxes quarterly. Yes, S Corp owners are still subject to quarterly estimated taxes on the projected profits. So there still is stuff happening in your financial backend with the S Corp. And in particular, the thing that I like to remind people is that it is adding accounting complexity to your business. I always steal a line from Spider-Man and say, with great tax savings comes great responsibility. You are saving money on your taxes. It is awesome. When I was self-employed, I was also an S Corp. It is great, but there is a trade-off, which is that there is going to be more accounting complexity in your business that you do need to be prepared for. I'm trying to arm you with that knowledge. So Sarah is going to run a poll. I want to hear from you all because you all just got to play with the calculator. Are you ready to start an S Corp? Let me know in the poll. And Sarah, let's close out the poll. 14% says yes, I'm in, 29% not just yet, and 57% says I'm still not sure. I'm going to talk to how those of you who are in and those of you who are still not sure, I'm going to offer you both a resource to help you get further clarity on if the S Corp is right for you. And then in terms of those of you that said not just yet, that's great. As long as you're making an intentional decision about your business and you're intentionally saying yes, I want to do, I know this isn't right for me now, but down the road, I can see where it would be right for me. That's great. We want you to walk away with that knowledge. For those of you that aren't sure or in, let's talk a little bit about how Collective can help. So this is what running an S Corp is like on your own without Collective. It looks a lot like the one I showed you earlier, but there's some new things in here, like calculating your reasonable compensation and setting up your S Corp and doing your S Corp tax return. And this is what your S Corp finance looks like with Collective. Basically, we are the S Corp experts and we specialize in S Corps for solopreneurs. So that means that if you are looking to start an S Corp and you are an individual self-employed person, Collective has worked with thousands upon thousands of businesses just like you, and we really know how to leverage the S Corp tax structure for self-employed people. We bring all of these parts of managing and running and setting up your S Corp, and we bring them all under one platform to make it easy for you. So we work with folks who are sole proprietors, single member LLCs, and any LLCs that are already filing as an S Corp. And we exclusively work with folks who are earning $60,000 or more in self-employed profits. Why is this? Well, remember when I did this and there was only 1K in tax savings? At Collective, we really, really want you to have the right structure for your business. And we know that while there's still a little bit of tax savings here, frankly, the cost of running your S Corp is going to eat this up. You're not really going to get that much back from it. So at Collective, our threshold of when it's a good time to start an S Corp is at $60,000 or more in self-employed profits. And that's why we work exclusively with people who are at this profit threshold. So let's talk a little bit more about what Collective does. I like to think of it always as one login to run your business. So we start with the LLC and S Corp formation. If you are a sole proprietor and you don't already have an LLC, we will form your LLC. And then if you already are an LLC, or even if we've formed your LLC for you, we will go through that process that we went over earlier of getting your S Corp set up. So we'll file that S election, get your EIN, help you with your operating agreement. We also offer monthly bookkeeping for all of our members. So you no longer have to keep QuickBooks. You no longer have to keep up with a spreadsheet. Our team of bookkeeping experts will manage your monthly bookkeeping for you. We also have an invoicing product, which is currently by request, but coming out of beta like so soon. So very soon. So we have invoicing built into our platform as well as monthly financial reports and something called an accountable plan. We did not have time to go over this today because we just didn't have enough time with the calculator, but there is another aspect of running an S Corp where you can have some of your personal expenses reimbursed by the business. And that's what's called an accountable plan. We have a really cool tool built in to the product itself that makes figuring out what your reimbursement is, submitting your expenses, super easy. We also offer payroll support. So with Collective, directly in the dashboard, you can run your payroll. So you don't need to invest in a separate payroll software. You can pay your contractors and file 1099s as well. This will take care of all of your payroll tax filings. And we also offer you guidance with that S Corp reasonable compensation that we've talked so much about today. And then, of course, tax support. So we do file your S Corp tax return for you, both federally and state. And every quarter, we also send you quarterly estimated tax calculations and reminders. Basically, every quarter, we say, hey, look, 1, your quarterly taxes are due, and 2, this is how much we believe you should pay based on the accounting information that we have on you, which is why it's such a benefit that we're doing your bookkeeping for you. And then finally, compliance and support. We send you annual compliance reminders letting you know when it's time to file that important paperwork for your entity. And you have a support team that you can message at any time. So Collective costs $349 a year. We also have an annual plan where you can save a little bit more. And there's a one-time onboarding fee of $199. This includes the tax returns, the monthly bookkeeping, the payroll tools that we talked about, invoicing, and Collective is also tax deductible. This fee also includes not the fee, but the cost includes retroacting your S Corp tax election. So if that's something you're interested in, there's no additional fee for that. It's not like we're going to say, We're not upselling you on it. We're not going to charge you more to do the retroaction. If you want to retroact it in your existing LLC, that's just part of what we offer to our members. Okay, so I said I was going to offer a resource for those of you who aren't sure, or those of you who are like, yes, I want to do this. And that is to schedule a free call with one of our business advisors. It's a free 20-minute call. Sarah's going to put the link in the chat. And this is a time for you to get clearer on if this is a good fit for your business. So especially for those of you that were like, I don't know, I'm still not sure, this is the resource. This is the next step, is to schedule that call. Again, it's free. It takes 20 minutes, and you'll be able to talk through your unique situation and really see, is this a good fit for me now, especially at the point in the year I'm at? Should I wait? Or should I really get going on this? We also have a special offer for our webinar attendees, which is 1 month at 50% off. So take note of this code. And with that, I am going to switch over to the Q&A and answer some questions. I'm just going to start at the top. So I can see, and usually we get questions that people ask about if there's going to be a recording or webinar slides. You will receive the recording within 24 hours. We don't share the slides, but you can watch the recording as many times as you want. So Carlton says, if you are an LLC, you didn't elect to be an S Corp or C Corp, what form do you file? So it's a great question. So if you are an LLC and you didn't elect any different type of tax treatment, you are by default taxed as a sole proprietorship, which means you are going to file you're going to report your income and expenses for your business on the Schedule C in your 1040. So basically, you're reporting everything within your personal tax return on the Schedule C. So this is a big misconception I see from people. They think because they're an LLC that there's something different that changes in their tax process or how they're taxed or the taxes that they paid going from a sole proprietor. But an LLC by default is taxed as a sole proprietor. So there's really no change. You're simply going to file your taxes on your 1040, which is the personal income tax return, with the Schedule C that reports your business income and expenses. Heather, I'm an influencer and speaker. Can I write off my salon? I am an LLC taxed as an S Corp. So can you write off your salon? I think you mean like going to the salon. I think you mean like your hair. So no, you cannot. So the IRS rule around things like this is that you really can't write it off when things that have personal benefit. So what you could write off is if you had a hairstyle. So if you had a photo shoot or a video shoot and you had your hair and makeup done for the shoot, you can write off the service of that. But having your hair just done regularly or your nails done regularly or things like that are generally non-deductible because you basically take it with you. So there's this like personal benefit piece that is like at the crux of this rule that generally makes it a non-deductible. Michael, I just did what she said you can't do. I went from a sole prop to an S Corp. I do not have an LLC or a Corp. So you probably have a Corp because you have to form something in between. It's a little bit confusing. What I would say, Michael, is to look at what's at the end of your business name, because an S Corp is not a legal structure. You will need, there's something that happened in between. What has likely happened is you went from sole prop to corp to S Corp tax status, but the way that the formation flowed is that it basically, the corp piece got rolled into like the S Corp tax status and the corp got rolled into each other. But I would encourage you to look at the end of your business name, and if it says Inc., then you are a corp. And if it says LLC, you are an LLC. But you can't go from sole proprietor to a sole proprietor yourself. A sole proprietor cannot ask to be taxed as an S Corp. So there's some legal structure in between there. They probably just got rolled in together in your formation process. What happens to the 100K? Isn't tax? So I think this is asking about, let's go back up to this guy, this piece here. What happens to this is it is taxed. It is taxed. Oh, the slides just did it for me. You pay income tax on it. So that 100K that's left over after, right, that pass-through profit, you're going to pay income tax on the pass-through profit. So it is taxed, but it is only taxed subject to income tax, not self-employment tax. KT. Single member LLC, S Corp elected, work from home. Can I write off part of the mortgage? You can write off part of your mortgage interest through the accountable plan. So that's, you can't write off the mortgage payment itself, but you can write off the interest on the payment. And the percentage is similar to the home office. So actually, Sarah, can you put the accountable plan article in the chat, please? So people have that as a resource, because we don't have time to go really over it fully, but I do want to like make sure that there's information for people. But essentially, you do the same calculation as you would for home office deduction, where you're going to take a percentage, you're going to measure the total square footage of your home, the square footage of your home office, take that percentage, and that's the percentage that you submit through your accountable plan. The key difference between the accountable plan and actually taking like a home office deduction is that when you take the home office deduction, it's a deduction that happens on your tax return. With the accountable plan, it's actually a reimbursement to you from the business. So this kind of funny flow where the S Corp reimburses the employee, you, for the expense, and that's a cash reimbursement, and then the S Corp writes off the reimbursement. So you still are writing it off, it's just like happening in a different place. Are you a SaaS product, or is there an advisor that will be assigned to my account in addition to the product? There is both. So you have a product and a dashboard and a platform, but you also have what we call our member relationship manager. That's essentially what your advisor that's assigned to your account that becomes your point of contact during your collective journey. So S Corp makes sense only when the LLC makes more than around 100K a year. I would say if you're making more than $60,000 in profit a year, then the S Corp starts to make sense for you. Any guidance on how to allocate distribution and salary? What's reasonable? This is the hardest part because the IRS does not give us a lot to work with here. I would say like to think about the factors you want to consider is how much money is your business earning, first of all, because if your business is earning $200,000 a year in profit, paying yourself $10,000 is not reasonable. But paying yourself $190,000 also isn't reasonable, right? It's not reasonable to pay all your profits to your salary. So you have to titrate a bit on what your business is profiting, where you live, what would be comparable in the market for your services, right? And then you're titrating that on what the business is earning. I would say that those would be the factors you would want to consider. Tiana, in the 160 example, if the owner's reasonable salary is 60, what happens to the other 100K? So I'm just going to repeat this because if it came up twice, then other people are probably thinking about it too. The other 100K is subject to income tax. So you're reporting that on your personal tax return, and then that money becomes subject to the income tax. Unfortunately, we can't make income tax go away with the S Corp. We can make self-employment tax go away, but we can't make income tax go away. KT. Can my LLC accepts both fiat and crypto for my consulting services? Can you or your product advise on crypto part of the tax flow fund? So unfortunately, KT, we don't work with folks who primarily accept crypto for their payment of services because it's outside the scope of our tax services. Is there a profit income minimum to file as an S Corp? So there is no like official minimum. So the IRS doesn't like have a minimum. The IRS is not going to like police that. You know, if you file the election for your business, they're like, cool, you're filing the election for your business. The guideline we use at Collective is $60,000 in self-employed profit annually. That's the guideline that we use because that's where we really see that the tax savings that you're going to receive outweigh the additional cost of the accounting and tax burden that you're taking on with the S Corp complexity. Hillary, I do not have an operating agreement. I have a single member LLC and I'm going to file under an S Corp. Must I have an operating agreement? You don't have to have an operating agreement, but it is best practice to have an operating agreement. And there's plenty of templates online. We even have a template as well. Maybe Sarah, if you could share our operating agreement template in the chat. There's so many templates online that it's like pretty easy to pull together an operating agreement. It isn't like a mandate, like you're not like out of any kind of true legal compliance by not having one, but it is best practice because an operating agreement can also stipulate things like who takes over your business if something happens to you, right? So there are some parts of an operating agreement. I know it can feel a little silly if you're a single member LLC because you're like, but I'm a single member, like it's just me, like I don't need an agreement with myself. But there are parts of an operating agreement that just formalize some of your decisions that can help you if something unexpected happens. Bill says, if I'm regularly paying various one-time video crew members all over the country, is there an advantage for using Collective for this? I would say the advantage is that, let's see if I can get back to the payroll screen, is that our payroll product, which is embedded in your dashboard, so one, the advantage is you have everything in one place, does enable you to pay contractors and it'll file your 1099s automatically for you. So if you're using our payroll solution within Collective to pay your contractors, come January where you have to file your 1099 next and send those out to people, it does that automatically, which frankly, having started my career as a bookkeeper, I have filed probably thousands of 1099s manually. And it's really nice to have a solution that just sends it out for you. I can attest that it does save time. It saves a significant amount of time, and it can be pretty stressful in January to try to do this too, because you only have to January 31st. If you're trying to chase down people or figure out what software you're going to use, or you don't have the information that you need, that can be really tough. And with this solution, basically, when you pay them, you onboard them in. So we have everything we need and those get pushed out. So I would say that that would be like a big advantage. And actually something that we heard a lot from our members this past tax year, a lot of our members talked about that was something that when they joined Collective, they were kind of more like on the like bookkeeping, I don't have to do it, yay. S Corp savings, I get to have that, yay, but didn't realize the value of this piece until they were sort of actively using Collective. All right, everybody. Well, thank you so much. Oh, somebody asked, is your payroll service included in the cost? The payroll service is included. So our philosophy, I'll just say this because I have a few extra minutes. So I'm just going to say our philosophy is what you see here. One login to run your business, all in one platform. That is what we are building. So everything that I've shown here in these slides that I went through, monthly bookkeeping and accounting, payroll, the formation, the estimated tax calculations, your business tax return, all of that is included in this one price. So there's no add-on pricing. And all of that is also in one platform. It's really cool. So you just have, like we say here, one login to run your business. Wonderful. Well, thank you so much, everybody. I think I got to all the questions. I do see a few in the chat, so maybe I'll just try to answer these really quickly. Shing asks, will I still be able to use TurboTax, or will I need an accountant after the S Corp setup? You will need an accountant for your personal tax return. Oh, I see now more Q&As. You will need an accountant for your personal tax return, but not for your business tax return. Tiana asked one last question. How long does it generally take to become an LLC and then an S Corp, considering that I have all my ducks in a row, provide all necessary info and docs? What's hard about this question is it depends state by state. There are some states that are like, literally like, you can set up your LLC in like 48 hours because they process so fast, and there's some that they don't process as fast. But I would say the main thing that you want to get set up is here is the LLC, because when you file the S Corp tax election, we can basically say, like let's say you set up your LLC July 1st, we can say in the paperwork for the S Corp tax election, we want it to start on July 1st. So the real thing is, how long does it take to become an LLC? Some of that depends on state processing times. Ooh, if you live in a state that's really fast, it can happen within a few days. If you live in a state that takes longer, it can take 2 to 3 weeks. The good news is right now is a good time to do this, because January is like all the processing times are elongated in January because everyone's doing it, right? So this is actually a good time where you would be on the faster side of those state processing times. So I would say 2 to 3 weeks max, could be a lot faster depending on your state. Um, uh, okay, I'm seeing two things happening. So Holly says, "Are you licensed to work in all 50 states?" We are. We work in all 50 states. So if you are in the United States, including Washington D.C., we can support you. Okay, and I see some questions about resources. So the operating agreement one is here in the chat. Sarah, can you post the accountable plan one here again? I'm going to repost the operating agreement. And Sarah, if you could pull the accountable plan, I think that's what people are asking about, is the accountable plan piece of content. And we'll do that. That'll be the last thing we get through the chat as we close up. So then people can get out of here and read fun articles about accountable plans. I'm sure just what everybody wants to be doing on a Wednesday is learning about accountable plans. I can also try to find it really quickly. All right. Oh, there it is. We got the accountable plan one in the chat. So everybody please check that link. Because that's the one that will go through more in depth about the accountable plan. And I know there were some people asking, AG, you asked, Krista, you asked about operating agreements. That one is there as well. All right, we're going to log out now. Thank you all so much for joining. I'm so glad you all enjoyed it and that you're walking away with some additional resources. I hope to see you all as a collective member. As a reminder, schedule that free call. Even if you're not sure, it will help you understand if this is a good fit for you or not.